REMARKETER. Empowering Realtors.
Good Tuesday morning, and thank you very much for joining me today. It's December and end of the year, and it's about this time of the year that market is slowing down more than ever, pretty much because of all the whole climate of 2023, and this is a good time for us to be able to recap the year and kind of forecast the coming year. There's a lot of talks about what's been going on over the past few months and what are to come in the coming few months going towards next year, and what could be the speculations and the effects on the market, on the real estate market, so far and going on from 2024 onwards. So what I thought would be interesting for us to discuss today was, going over some market analysis, looking at market statistics and the different tools that are available in the market, and kind of looking at everything from the analytical point of view, and be able to kind of put all these numbers into perspective and understand what can be done in terms of helping our clients understand the dynamics of the market better. In terms of pricing strategy, in terms of the whole decision making, whether to buy or sell, or when is the right time, et cetera, et cetera. Everything makes better sense when you have the ability to explain the numbers to your clients. So this is what we're going to be talking about today, and this is what we're going to be focusing on, using several different tools. But everything would be looking at ways to analyze the numbers and understand and explain the numbers that we see. All right, let's go ahead and start our discussion today. The first thing that I want to show you, obviously, is market statistics. So, if you go to your website, you have some market reports available here, which that you can change under website configuration. So the cities that you want to promote here under market stats would be the cities that you are mainly active in, and therefore you'd want to display the fact that you have the ability to analyze the market as well. So right off the bat on your website. So these are available on your under the market reports tab. If you haven't enabled these, go ahead and enable them. It's very important for you to do so. Go to website design, website config, extras, and select your areas of interest right here under market reports. So these 4 areas are exactly the same 4 areas that you see under here. But looking at the market statistics on your website provides a lot of useful information that you could use on your own website to explain some of the dynamics of the market to your clients. Let me explain to you what are the different elements that are available on this page, and then we're going to go to the back end where we have more numbers and elements to work with. So the first part up here is the like a heat bar, where the system calculates and displays to you whether the market is a balanced market, a buyer's market, or a seller's market. The way that this is defined is by a variable called SNLR, which is sales to new listings ratio. So basically what happens is that the standard practice is that you take the number of sold properties in a given period of time, let's say 30 days, and then you divide that by the number of new listings on the market. So if you're in the bracket of 40 to 60%, you would be in the balanced market area. So this is where we are right now. If you're less than that, you would be in the buyer's market area. And if you're more than that, more than 60%, you'd be in the seller's market area. So the more sales we make versus the new listings that are coming onto the market, we would be more into the seller's market portion of this bar right here. Now, the way it's been in the GTA for the past many years is that we've always been playing around in these areas, but sometimes happened that we've had buyers market conditions in certain parts of the market. Now, it's very important for you to understand, and it's very important for your clients to understand, that the dynamics of the markets are very different from pocket to pocket, even within a certain uh, you know let's say areas such as the GTA, for example. A lot of the real estate agents, what they report and what they study and analyze is the GTA market statistics. But we have to understand that this is such a generalized set of numbers that it really doesn't make sense to generalize these numbers over the whole area of the GTA. I will show to you shortly how markets in different pockets of the GTA are completely different, and the way that we analyze and we look at the numbers would be very different in the different areas of the GTA, let alone areas outside of the GTA that are farther apart from each other. So I mean, if we look at the whole Ontario, we're looking at many different types and dynamics of the markets. I mean, there's no way you can compare Ottawa to Hamilton to Barrie to Innisfil to New Tecumseth or to any area in the GTA. These have all their own dynamics and their own criteria when it comes to supply and demand. And therefore, we have to study each one of them individually in order to be able to understand the dynamics of that specific market. So at this instance here, we're looking at Aurora. And this is the situation in Aurora. You might find a very different situation if you look at, Brampton, for instance, or Hamilton, or Niagara Falls, or whatever. All right. So in the past 30 days, we've had 50 properties sold, and then we've had the average sold price to be at $1.3 million. That's the average sold price. That's a 95% of the average asking price. So right here, we can do the first analysis here. So you can see that most of the properties are selling less than the asking price. So that's one dynamic that you can see, and it's about 5% less than the asking price. And this, is a general dynamics of this market right there. We've got the benchmark price and then the 1-year price appreciation, which is just 3% year to year comparing to last year. I will get into these numbers when we get into the back-end market statistics, where we can explain each individual number more in detail. You've got a 3-year price change, 5-year price change, and 10-year price change, all of which are based on the benchmark price. And remember, benchmark price is different than the average price. That's why we have both reported here, even though they're very close at this point of the time, but they could be quite far apart as well, especially for different property types, which again, I will explain when that happens. We have the trends here, which are the average market price, which you've seen has had its ups and downs. And then we've got the average days on market, which you can see is growing, and then, kind of the, curbing right here. And then we've got the average, the market activity. This is my favorite chart, and I would explain to you why. This is usually my go-to chart when I want to do any kind of a prediction in the market. So I'll show you why and how. So this is, one set of market stats that you have available on your website. But if you want to do some, really in-depth market analysis, it's best to go to the back end where you have access to more information at the same place. So let's start off with the market reports. This is the main module that you're going to be able to use in order to generate any kind of market analysis or market statistics or statistical information, if you want to say it. I'll start off with the TREP market report. So these are the market reports provided by the Toronto Real Estate Board, which you could use to analyze your market statistics. There are other elements here as well that I will explain. Okay, so you can see that we still have the same elements here as well, a little bit more for us to be able to use as well. But you can see here the sales to new listings ratio for the GTA is at 40%. So when you're looking at the GTA, we are, quite at the limit where, buyer's market is going to be defined. So this is the situation for the GTA, but we just saw that Aurora was right over here. So we have a different set of dynamics playing in that pocket of the market compared to the general situation in the GTA. So when we're looking at this report, which is usually 95% of what's being reported out there by the news media, by real estate agents, etc., is the GTA market report, which is the entire GTA and for all property types, which, obviously when we're looking at a detached property to be sold in Pickering, we are not advised to look at these numbers for any kind of analysis because it just doesn't apply to Pickering, as we can see. So let's go ahead and choose Pickering right here. You see, it shifts and the dynamics are different. If we want to sell a property in, let's say, Newmarket, we can select that area, and then you can see, again, it's shifting. So let's go to Brampton, for example. We have another set of dynamics again. And let's take a look at Toronto, let's say, let's just do C8. It's even further down towards the buyer's market situation right here. Let's do a C15. Now it moves back up. So you can see every pocket is different. So it's much better if you just select the pocket that you want to study and focus on the numbers and statistics that you got there. You've got relations going on between the different areas, but it's best to focus as long as you have credible numbers to do your analysis. Let's go back to Pickering for now. And look at the numbers. All right, so we've got the average sold price in Pickering, which is -2 year over year. So basically, the average sold price has come down year over year. We've got 82 properties sold, and the year over year number of properties are up 11%. So we've sold more properties compared to the same period last year by 11%, but we've sold those number of properties, so basically the extra 8 or 9 properties, at a lower price compared to last year. So this is what we're looking at right here. So these are all 30-day numbers. So these are all the monthly numbers for November 2023. But when we're looking at year-over-year numbers, we can see that we're sold more properties at a less average price. The average DOM is gone up year-over-year by 6%. So properties take longer by 6% to sell. And then we've got the active listings, which is, again, up 40% year over year. So we've got a lot more properties, 40% more properties sitting on the market. So those are the number of active listings at the end of the period, at the end of November, that haven't sold yet in that market. So you can see the dynamics right here. You can see that there's a growing gap in terms of the number of active listings versus sold listings. Even though we are selling more properties by 11% compared to last year. We have 40% more properties sitting in the market compared to last year. So these are all things that we need to consider, and you can see them all in this chart, which I just mentioned is my favorite chart because it really portrays everything for you, and you can easily see what's going on. So that thing that we were just talking about, the 40% more active properties, you can easily see that in this graph right here. So we had 148 properties active in November of 2022, but in November of 2023, we have 248 properties that are active in the market. So you can see that there's a huge increase here. So there were much less inventory back in 2022 compared to the inventory that we have today in November of 2023. So that's a big indication of how the situation of the market is right now. Now you can see that we've got sales at 74, and this year we've got 82. So that's the increase that we saw here, the 11% increase in the number of properties sold, which is not as great as the amount of inventory that we have here. So we've got a lot more inventory today compared to the same period last year when it comes to number of properties. Now, let's go back up here and take a look at the benchmark prices here. So the benchmark price is $999,800. I will explain to you again what a benchmark price is so that you would be able to explain this to your clients easily compared to the average price. So I'll just give you a quick example, and that's the best way to explain the situation. The difference between these two here. So let's imagine that we are looking at a very small neighborhood during which 4 properties have sold, right? Let's say 3 properties have sold during a period of time. Now, if we want to average calculate the average sold price, what we need to do is to add these sold prices. So let's say one of them sold for $1 million, the other one sold for $1.1 million, and the other one sold for $900,000, right? So we add these up. So added up, it'll be $3 million divided by 3, it'll be $1 million. So basically the average sold price in that neighborhood turns out to be $1 million, right? Now, what we do with the benchmark price is that the benchmark price will look at the typical properties of that specific neighborhood. So let's say these 3 properties are all typical. The typical properties, let's say 95% of the properties in that neighborhood are, 70-year-old bungalows, 3 bedrooms, and no pool, for example. And then, some other features as well. So to calculate the benchmark price, what they do is that they go out and look at all these specifications of the general properties in a certain area. And then they decide them, and then, they apply the prices, the sold prices to those criteria. And that's how they calculate the benchmark price. Now, let's keep it at that. Let's imagine that the benchmark price is $950,000 there. All right, so it's a $50,000 gap between the average price and the benchmark price. But here's when things become interesting. Let's say next month another property comes into market and sells in this market, which is brand new. Luxury custom-made property in that same neighborhood comes to market and sells, let's say for $2.5 million there, right? So next month, let's say we have another 3 properties that sell. This time, one of them is sold for $1 million. The other one is sold for, let's say, $1 million as well. And this third one, the brand new custom property, let's say, sells for $2 million, right? So now we have $4 million divided by the number of properties sold, which, let's say, brings the average price to $1.4 million, right? So average price last month was $1 million. average price this month is $1.4 million, right? So when you have $1.4 million versus $1 million last month, is it correct to say that the market's average price has grown by 40%? So the market is heating up and the market is picking up and the properties are selling for way more by 40%? Of course not. The reason why we see such a jump in the average price is because of that single property. That's an outlier. It's not a general typical property of the neighborhood. It's a very different type of the neighborhood property in that neighborhood. It could be the other way around as well. We could have had a property that sells for significantly less than the average property in the neighborhood, and that would dip the price, the average price in that neighborhood, which is, again, wrong to assume that the market is shifting. It's not the market that's shifting. It's one outlier that's making it seem like the average price is changing. All right. So the average price did change and that property did sell. So it's correct to say that the average price has grown by, let's say, 40%. However, it's not correct to say that the market has grown by 40% in that neighborhood. All right. That's when the benchmark price comes into play. Benchmark price does not consider that outlier. It's not even going to take into calculation that luxury custom built property that sold for significantly more than the average properties there. It will only consider the average properties there. So we have two more properties that sold during that period of time, both for $1 million, and therefore the benchmark price will still be calculated at $1 million. So last month it was $1 million, this month is $1 million as well. So the benchmark price has stayed the same. So now we can understand the importance of benchmark price. We can see that the market, in fact, was stable from last month to this month. Nothing has changed. $1 million and $1 million. We only had one outlier which sold for $2.5 million, which is a lot more than the average market. So the market hasn't shifted in that neighborhood. It was just that one property that came into market. So that's why, especially when you're more focused and you're looking at lower number of sales, it's much, much more important for you to also keep an eye on the benchmark price in order to understand the fluctuations in the market. So average prices tend to fluctuate a lot more because properties come into market and sell for ridiculous amounts, and they affect the average price. But benchmark price usually just takes into consideration the natural fluctuation in the market, the general market, the actual market, what really matters in that market, what really builds 90% of the market, 80-90% of that specific market, and it looks at every pocket. So it's bottom up. So that way, benchmark price is much better for you to consider when you want to consider fluctuations and you want to compare to points or area to areas without worrying that you're looking at properties that might not be of the nature of the area. So that's why we have the benchmark price here as well. So you can see that the benchmark price and the average price are side to side. Now, usually when the market is balanced, the benchmark price and average price tend to be, neck to neck. So they're very close to each other, as you can see here. Now, if you go back to when the market was super hot a year and a half ago, you would see that the average sold price is higher, sometimes significantly higher than the benchmark price. The reason for that is that you have a lot more of those outliers selling in the market, right? So the properties would be priced at $1 million, but they would be purchased at $1.1 or $1.2 million. That doesn't mean that the market's value is growing at that pace. It's just that the demand is so high that the buyers are willing to overpay for the properties. So the benchmark price, it's still correct, but the average price is a lot higher because there's a lot more demand. And that usually shows you that the market should be in the seller's market areas, when you see a difference in average price, when you have a higher average price compared to the benchmark price, and the other way around as well. So when the market really cools down, you see that the average sold price is smaller, is lower than the benchmark price. And you can see here that the average sold price is lower than the benchmark price, and therefore we're looking at, we're a little bit more leaning towards the buyer's market right here. So if this is significantly less than the benchmark market, then we are, definitely in the buyer's market zone right there, where people are allowed to just place in offers that are significantly less than the asking prices. So that's what we see here between these two. So when you compare these two, you can kind of forecast what's happening here in terms of, for instance, listing to sale price rate. So where is it? Sales price to list price right here. So we're at 100% right here. So we're almost the same. If this was a little bit further down, you would see, things like 95% of sales price to list price. So these are the things that really kind of go hand in hand with each other. Now, looking at benchmark price change over 3 months, we've had a decline of 6%. Over 6 months, we've had a decline of 5%, and year over year, we had an incline of almost 1%. So that's the benchmark price for you. So this is basically showing you, even though we've had so much fluctuations in terms of average market price, the benchmark price over the past 1 year has pretty much been stable. So we are at the same kind of prices that we've had last year in Pickering. This could be different if you look at, for instance, let's say Oshawa, which is like 2 towns to the other side, or if you're looking at, let's say, Oakville. All right. So in Oakville, we're negative 3.2%, negative 13%, and negative 8%. You can see that the situation is very different there. Okay. This is a good example right here. You see this spike, a huge increase in prices. That's average price for you. These are outliers, right? You can't really think that the market in Oakville has grown so much over the past 1 month, October to November, but it has. That's because of the average market price, because there are properties that have sold here in the market that were simply expensive. These were, new builds, bigger properties, more luxurious properties that have come to the market and sold. They might have sold for significantly less than what they could have grabbed a year ago, but they sold, and that's why the average market price just jumps up. However, when you look at the benchmark price, you see a different story. You see that? That's why it's very important for you to always keep track of the benchmark price. Do not be fooled by the average price there, right? And this is usually the case with your clients as well. They might come to you with the average price that they see in, I don't know, whatever newsletter that they, is dropped into their mailbox. But you have to be able to also explain to them that, why sometimes you would see abnormalities in average market prices because of those outliers there. All right. Then we've got the whole thing broken down into 4 different categories: the detached benchmark price, the semi-detached benchmark price, the townhouses and condos. So we're looking at different property types. So even though the benchmark price is 1.3 almost, the detached benchmark price is 1.7, semis are at 1, townhouses are at 837, then the condos at $670 there, right? So you can look at Pickering again, and we have the same thing broken down for the different property types as well, with a 3-year growth, which is, usually a good enough cycle for you to monitor growth. So Detached properties have generally grown by 28% over the past 3 years, semis by 25%, townhouses by 23%, and condos by 30%. So the most growth in capital over the past 3 years has happened by condos, which is, pretty similar to all the other property types as well. In some areas, these are very different, right? So you see a lot more appreciation in detached properties, let's say, compared to condos, or vice versa. So these are, again, another set of information for you to monitor. All right. Let's take a look at this market activity. Well, this is the average price, and it's self-explanatory, but I want to show you the relationship that we see here to this average price right there. This is a really good set of numbers to look at. I like to start with the market activity. This is a very important chart for you to understand and analyze all the time, because it helps you predict. It helps you look at the future a little bit as well, which is always what we want to be able to do, right? So look at what's happened. Let's compare November to November to begin with, right? So November 2022 versus November 2023, two very different markets, very different. If you remember November 2022, we were looking at a very different market comparing to what is happening right now. Okay, over the course of the year, we've had significant raises in interest rates, which has greatly affected the market. But you can see how things take turns and how things affect each other, and how the market is reacting to the geopolitical conditions of the market there. All right, so November 2022, you could just hover over the numbers here and you can kind of see what had been going on. You had 148 properties active at the end of November. You had 148 properties listed during that period of time, and you have 74 properties sold. So you pretty much sold 50% of whatever was listed in the market. That's what had happened. 74 versus 148. So whatever was listed on the market was sold. 50% of it was sold. And then at the end of the month, you had 148 properties still available in the market. All right. Now let's compare that to November of this year. When you look at this, we have 173 properties coming to market, and we sold 82 of them. So again, almost 50% of whatever was on the market was sold. However, we have 248 properties still in the market and not sold. All right. And that's because we are carrying over a lot of properties from the previous months. So we're still having a lot of properties available in the market. However, you can see that there was a sharp incline and a sharp decline right here happening during September and October of 2023. So now things can start making sense to you, and you can look at these numbers and see what has been going on over the past few months. So what had happened here is that you can see that we've had a consistent decline in demand over the past starting from May 2023, and you know why this has happened, right? So there's less and less demand. Now in this pocket, which is Pickering, remember we're looking at Pickering right now, we've had a growth of inventory, right? So May, June, July, there were more and more properties coming onto the market while demand was going lower and lower, right? And then this started to build the inventory. Okay, so as the demand dipped here, inventory jumped up. So we have a lot of inventory available, and there was a lot of properties being listed during these months right here. And these are exactly the same months that you can see the price dropping down. Why is that? So as soon as you see the jump right here, April to May, there's a jump in new listings. There's a lot more listings, while um, sales grew a little bit and then immediately started to go down. Immediately you see the peak right here and then the fall. As soon as there's more listings versus demand, prices will go down, right? So if you were sitting here, let's say here in this month, July of 2023, and you were looking at this part of the um, in June of 2023, and you were looking at this part of the graph right here, you didn't have any of the other numbers right there. You could see that the number of listings that are being listed are going up. However, the demand is going down. So what would you expect for the next month to happen in terms of the average prices sold? I would say that the average price sold would decline, because I could easily see that the demand is going down while inventory is going up. So unless something dramatic happens, prices should go down during July, June and July of 2023. And let's go ahead and check what happened in June and July of 2023. Prices did have a big decline because of this huge gap, opening of the gap. So now we can go ahead and take a look at this. Obviously, as a realtor, you should also consider all the other natural factors of the market as well. Seasonality, a big one, right? So December and January are naturally slow times in the market every year because of everything else that's happening there, right? So the seasonality has got its own effect anyway. However, supply and demand is the biggest player in the market all the time. So even if it's the coldest winter that we have, we could have the hottest market ever, because there could be a shift in supply and demand. But let's take a look at how things are shaping up here. So demand is kind of stabilized. So we have small demand, but it's almost as much as last year. It did decline, but then it inclined again, and then it declined again, but it's kind of there around the 70, 80 properties that are selling. So we have a kind of stable demand right there, but you can see that the inventory has sharply declined, right? So there's a lot less properties available to sell. A lot less properties are being listed right now, and a lot less properties are available to sell. So the inventory is also shrinking as well. So what would that tell you is that, um, the gap between the supply and demand is closing, right? So that tells me that we should see not a huge, but at least a little bit of price increase during the month of December. And you can see that kind of tip right here as well. So you can see that the price increase is kind of starting right there. And that started when this decline started to happen right there. Okay, so you kind of see that price increase is kind of happening. So even though you wouldn't expect from a seasonal perspective for prices to go up in December of 2023, which we are living in right now, the numbers here suggest that because this gap is closing very dramatically, we might see a little bit of price increase during December of 2023 for this pocket. Obviously, you might look at another city and things would be different, right? So this is how I can kind of see what's going to happen, and you can kind of relate all of these numbers with the numbers that you have here as well. So what happened? Let's go throughout the whole year. So we started off November 2022 with pretty much selling 50% of whatever it's listed in the market, and then we had a quick decline in the number of properties that were listed. So during December, a lot less properties were listed. That's seasonal for you. And we're experiencing the same thing kind of right here. So we would expect even less properties to be on the market during 2020, December of 2023, right? So this should even go further down, as it had happened in 2022 as well. It had a sharp decline, and then demand declined as well, here, and it should decline here a little bit as well. So, but this is going down even faster. So we kind of look at the same situation right here, which had created a price increase right there. So supply goes down, price goes up. Our inventory was sold a little bit, and then we have some further properties coming into market in January, and then February to March, we've had more properties come into the market, and then this is when things started to go haywire, right? It created a kind of a rush in the market, and we've had a lot of properties coming into the market where demand didn't really keep up, right? So that's why we had the big decline in the prices until inventories started to shrink as well, where we have prices going back up again. Now the differences are not that much; they're not huge here, but you can see the effects of the supply and demand right here onto the market as we look. So this is why I say, studying this graph is very, very important for you, because it really provides you with a lot of insight. We can see that the DOM is going down as well. That's, again, the effect of this dramatic decline in the amount of supply there. So you can easily see what's going on in the different times of the year. All right. Now, if you want more up-to-date market statistics, you could go to the City Market Watch, where you can see the same thing. For instance, let's go to Pickering. We can see the same thing, but updated weekly rather than monthly. So this one is more up-to-date, and you can kind of see what's happening in the past 2 weeks of December as well, right? So if you want to look at the numbers further into December, you can come to this module where you can get more up-to-date numbers. Obviously, these numbers are not filtered. TREP's numbers are filtered at the end of the month, and anything that didn't go through or anything that needed corrections, etc., are going to be corrected before the release of the numbers. But these are just raw numbers. The exact numbers that come into the database, the calculations are done and displayed for you right here. So you see that price increase that we expected? It did happen. It did happen. So you can see that how you can really start predicting there. So the decline is continuing in the new listings, the number of new listings. The decline in active listings is continuing as well. Demand is also declining. However, it's not declining as fast. It's kind of, stabilizing right here, kind of. So we did see the price increase, but probably not any much more going into the new year. So you can kind of see how these numbers really tell you the whole story. So, practice with this. Go from market to another market and really see what's going on in the market. Okay, so I think this is enough with this one. I want to show you another piece of information as well, another tool that you can kind of look at with an analytical point of view as well, and that is the CMA. So let's move on to that one as well, and check out the CMA as well. Now, I found a rather normal property in I think, yeah, it's in Aurora. Right? It's a rather normal property that's, on the market for sale. I want to do a CMA. So what I'll do is that I'll take this property ID, and I'll go back to the system. Let's go to the instant CMA module and put in the MLS number. This is a great tool for you. I mean, if you're not using this, you should. It's such a great tool that can give you a lot of insight. Specifically on properties. All right, so we've got a couple of different things that you can use. So the first thing here is that the time adjusted estimate. So this property is listed on the market, but it was sold back in 2021 at $1.165 million. million. So let's go back to November 2021. So firstly, a little bit of story that you can tell your clients here about this property is that, it kind of seems like a stress sale, right? Seems like it. I don't know, because they bought the property in November of 2021, and now it's less than 2 years out, and you want to sell it. And it's been sitting on the market with the price change, right? So, they really want to sell after 2 years. Yeah, so that's the number one question mark right there. So it kind of seems like they need to get out of that deal um, at whatever price. However, looking at the adjusted time adjusted estimate, so what this does is that it takes this price, which was sold back in November 2021 at $1.165 million, which is a bit more than the list price. So they paid over asking here. And the system adjusts this based on the benchmark price growth since then, right? So if we apply the benchmark price growth since then to this last sold price, which is 1.165, we will come to $1.253 million. So you can see that looking at the fluctuations of the market, unless this is not a typical property of the market, let's imagine that the guy spent, I don't know, $200,000 renovating this property over these 2 years. So obviously it is worth more now, right? However, if it's the same property, the fluctuations of the market will land the price, even considering the overpayment here that they've had, to 1.225. And that is considerably less than the $1.4 million that this property is listed at. So looking at it from purely analytical perspective, you would expect for this property not to have an easy sale. So that's why it's still on the market after 53 days, and it could still stay on the market because it's much higher than what the market would expect, right? Again, these do not apply if you go to the property and you see a magnificent property that's a catch to buy. But that's all up to you and your client to decide. But statistically only, that's what these numbers are. All right. So you won't see this number if you don't see a lot, we don't have a recent sale for the property. Otherwise, this is what the HPI is going to suggest. Then we have all the other items here as well. So the average sold price for detached properties in Aurora within 1 kilometer of the subject property is 1.165. Again, you can see that this is much higher than the average price there. However, you should always pay attention to this next number right here. The number of sold properties in the last 30 days within 1 kilometer of the subject property was 1. 1 is not enough for any kind of analytical decision making. So that 1.165 is that one property that's sold. That's the average price of that one property that was sold. So this is the price right there. And it's not, a good enough basis for you to make any assumptions in terms of average properties. But the number one story that this tells you is that, properties are not selling as much in the immediate neighborhood, 1 kilometer radius, right? So what do? Let's go ahead and increase it to, let's say, 2 kilometer radius. All right. So now I increase the radius to 2 kilometers around this, and now I have 9 properties sold, and the average sold price is now $1.4 million. So now things might make a little bit more sense right here. Okay. So now I have 9 properties to kind of evaluate based on. So those 9 properties that sold within 2 kilometers of the radius on this property, the average price was 1.4, which is closer to what we have right here. Then we have the average DOM, the average SPLP. We've got the 1-year price appreciation, 3, 5, and 10-year price appreciation for detached properties, which is what this property is in Aurora Village, which is what this neighborhood is basically. All right. And then we have the comparative properties. Let's go back and bring this back to 1 kilometer. All right. So 1 kilometers. These are all the properties that I've sold, and you can see that they were sold. There was only one sold in December 2024, and then the rest of it was like October, and October, right? So you can see the one in December was listed at 1.18 and sold at 1.165. This property obviously is cheaper than this property, so we know why. Right, but it's this one is a 2-story, this one is a bungalow. Then we have side splits in another 2-story and another 2-story here. Okay, so if you want to compare apples to apples, obviously we're going to switch on style here, so it will only look at 2 stories. See, so now it changed, but we don't have any recent sales. The most recent one is October 19, 2023. We sold for $1 million right there. Okay, and then we have another one, 98% of the asking price, 1.5. So this guy priced it at lower than the average price back then, or even the benchmark price, and then sold it at 110% above asking. But looking at other properties there, we've got properties with even a pool in the backyard, selling at $1.16 million. So no wonder this is struggling to sell. So we're looking at it from an analytical perspective. We're only looking at numbers right now. We're not looking at the actual properties and the qualities of the properties. Those are up to you guys to go in there and look at it and evaluate the situation of the property based on the experiences of an actual realtors. Right now we're only looking at numbers, but the numbers are telling a different story. The numbers are saying that a $1.4 million property is going to have a hard time selling here. Now let's go ahead and set the boundary to 2 kilometers again, so we have more properties to look at. And I'm going to say to this style again. All right, so now we have a different set of properties to compare with. And again, 99%, 91%, 97%, and 100%. So 1.3 million, 1.1, 1.2, 1.1. So even going further out, 2 kilometers, looking at same style of properties, we're not around $1.4 million. So again, the numbers are pushing us down. The numbers are against us in terms of if we were the sellers of this property. If we were the buyers for this property and we were considering purchasing this property, it seems like we have some room to negotiate comparing to all the other properties out there that have sold, and the fact that the adjusted time price is also suggesting a different number, and the fact that the property has been sitting on the market, and the fact that they probably need to sell the property. So these are all in our benefit, and we can really play our or pull our strings differently when approaching this property right there. So you can see how using the numbers can really give you some analytical insight into the market, and you'll be able to have some numbers to play with. So if you're going around looking at properties in this neighborhood, you now have some numbers to remember, the 1.4, the 1.2, the 99% and the 91% asking prices, and all the 1.2s and 1.3s. So these are the numbers that we'd be looking at when going to different properties in this neighborhood within at least 2 kilometers of radius. And that's how you can have an analytical approach towards the market. Now, obviously, there are other things to consider as well. So, for instance, the lot size, you can compare these. So, when you really get down and deep and want to really see how the property could be valued, yeah, all of these elements come into play, whether the basement is finished or not. And again, nothing is in favor of this property right here. The basement is unfinished. We've had walkout, separate entrance properties sell for less. Then we have, I don't know, looking at the lot size, it's a quite deep lot size. So that's probably the only upside of this property. Comparing it to this one, though, not again. So this one is even bigger. So, you would still have to do your own realtor thing, but I'm looking at, purely numbers and average sale prices and competition and what's going on. Competing properties is, again, another important thing to consider as well. I mean, if you have a lot of 1.1s and, there's a 1.5 here, there's another 1.5 here, there's a 1.2 and a 1.5. So there are properties in the market competing with this one that are listed at higher prices than this one. So that could be a positive point for this property our subject property here. But again, we've got 1.1s here as well. In the immediate neighborhood, 1 kilometer, we only have 3 competing properties, all at around the same price. So this could be probably the only positive side for this property right here. So it is the cheapest available property in the immediate neighborhood. Everything else is more expensive. So that's one positive conclusion that we would have there. So if that specific neighborhood is your must-go-to neighborhood as a buyer, then you're looking at the cheapest property right now. And the cheapest property should be able to sell. Nevertheless, the fact that, all these properties are sitting in the market, probably for the same reason. Okay. So let me start here and stop here, sorry. And yeah, it's already 11:27. It was a long session. I really appreciate you guys spending the time with me. I don't see any questions in the comments section, but if any questions come up, certainly send it our way. We'd be more than happy to help. But, these are interesting stuff. Numbers, and, the better you are with numbers, and you can take these numbers and go to social media and talk about it for 10 minutes and, gain a lot of positive and negative interactions, which is okay either way. In social media marketing, remember, I mean, even people get back to you and negatively, it's still positive because you're gaining traction on your social media. So, these are interesting things to talk about, especially now that numbers are making a lot of noise out there in the media, in the whole market. So it's good to be able to be in command and be able to explain these things to the consumers. All right. I hope you have gained a little bit out of our discussion today. And again, I hope you enjoy the rest of your day. Stay safe and warm, and I'll see you again next week, same time, same place. Enjoy.